You know, the best investment opportunities usually appear before the numbers do. When the business starts changing, but the market hasn't fully priced in yet. So we did the homework and we went through dozens of recent earnings calls and shortlisted 10 small cap companies where management expects the next phase of growth. But we didn't stop there. We checked whether that growth is already visible through stronger order books, capacity expansion, new products, and expanding markets. So here are the 10 companies that stood out, which we'll be covering in this video. For each one, we'll break down what's changing in the business, the key growth triggers, the numbers behind the story, and the biggest risks you should keep in mind. So let's get right into it. Stock number 1 is Hind Rectifiers. Most investors still know Hind Rectifiers as a railway parts manufacturer, but management is trying to completely rewrite that. Now they want to build the entire propulsion system, think of it as the train's engine. And that one change is huge for revenue. Earlier, per locomotive, they used to earn around 1.5 crore. Now, with the full propulsion system, that number jumps to almost 5.5 crore. So the same train, but more than 3 times the money. The stock is currently trading around 1050 rupees, with a market cap of about 3600 crore. Then there is a new 56 crore copper conductor plant which just started commercial production. Now copper is a key raw material for them, so making it in-house pushes up margins and adds a new revenue stream. And beyond railways, they are now exploring defense, mining, renewable energy, even power management for AI data centers. Now let's look at the numbers. FY26 was already a strong year, standalone revenue up 52%, EBITDA up 20%, profit up 21%. And for FY27, management's guiding for another 30% growth on top of that. The long-term ambition is to take revenue from 949 crore today to close to $1 billion over the next 5 years. Now let's look at the risks too. All of this growth depends on whether propulsion orders actually start flowing like they are saying. So that's a key thing to watch here. Now let's move on to stock number 2, Anup Engineering. They did something unusual here. They walked away from nearly 200 crore worth of orders on purpose. Why? Because management didn't want to chase revenue at the cost of profits. They chose better margins over bigger sales, which is a sign of a disciplined business. So what does the company do? It manufactures heavy engineering equipment like heat exchangers, pressure vessels, and process equipment which are used in refineries, petrochemical plants, and energy projects. But the business is also changing. They are expanding into technical services and complex engineering solutions where margins are much higher and customer relationships tend to last longer. In fact, the new technical services business has already executed 10 orders and is targeting 200 crore in revenue over the next 3 years, with margins of nearly 40%, which is much higher than its core business. The stock is currently trading at around 2,100 rupees with a market cap of nearly 4,200 crore. To support future growth, it has also commissioned phase 2 of its Khera plant, which will increase its annual manufacturing capacity to around 1,200 crore. Then the company is also entering into new segments like nuclear power, thermal power, clean energy storage, air-cooled heat exchangers, and skid packages. The numbers also look encouraging. It has an order book of 769 crore, an active inquiry pipeline of 1200 crore, and has consistently maintained EBITDA margins above 20%, which is stronger for an industrial engineering company. The key risk here is that a large part of its revenue still depends on a few big projects. Now let's move on to stock number 3, Rossell Techsys. Rossell builds the electronic systems that power aircraft, defense equipment, satellites, and semiconductor machines. Its customers include global names like Boeing and Honeywell. And here's why this business is genuinely hard to break into. Once a customer qualifies you, they don't switch easily. Every wire harness, every testing system has to clear years of certification. So the real barrier here isn't money, it's trust, which is built up over years. And Rossell spent a long time earning that. Now, does that show up in the numbers? Yes. FY26 revenue climbed to 485 crore, EBITDA jumped 73%, and profit before tax was up a massive 165%. Management's guiding for another year like that in FY27, which basically means close to 87% revenue growth. What I find interesting is how the mix is changing. Aerospace and defense used to be nearly the whole business. Next year, it will likely fall to just about 50% because semiconductors and space are scaling up fast. Management's expecting both of these newer segments to grow 300 to 400% in FY27. And that's already visible. They have gotten a confirmed order book of 715 15 crore, strategic agreements worth over 3,000 crore and bids worth close to 4,500 crore still under evaluation. They've even leased a new 2.1 lakh square feet facility just to make sure capacity doesn't become the bottleneck. Now here's the part you need to know. At today's price of around 963 rupees and a market cap of around 3,630 crore, this stock already trades at close to 160 times earnings. That's a rich price. It means a lot of this growth is already baked in. So execution has to match the story here. Now let's move on to stock number 4, Wakefit. You probably know them through their mattresses, but they don't want to be a mattress company anymore. Their real ambition is to become India's one-stop home and furnishing brand. Right now, mattresses are 61.4% of revenue, furniture around 29.3%, and furnishings around 9%. The idea is that a customer who buys a mattress today should eventually return to buy a sofa, a dining table, home decor, and other products, all within the Wakefit ecosystem. And that changes the size of the opportunity completely. Even with demand being a bit soft right now, management's still guiding for 20% plus revenue growth in FY27. And market cap sits around 4,000 crore. But this flywheel only works if Wakefit actually owns the customer relationship. That's why 67% of their annual sales already come through their own website and their own stores, which gives them better margins. They also get customer data and they use it too. They are also planning to add over 80 new stores in FY27, push deeper into Tier 2 cities and launch their first jumbo store, which is over 100,000 square feet, meant to show off an entire home, not just one product at a time. The risk here is pretty simple. This needs near flawless execution. Now let's move on to stock number 5, Premier Explosives. Recently, there was news that Apollo Microsystems could acquire Premier Explosives. Now this isn't just another acquisition. Think about it. Apollo already makes defense electronics, Premier makes explosive, detonators and propulsion materials. Put the two together and you're looking at a much more complete defense business. So what does Premier actually do? Its products go into missiles, aerospace and defense programs. And this isn't an easy business to enter. You need specialized licenses, years of technical expertise and long approval cycles before you can even become a supplier. That's a big reason why competition stays limited. Management now expects around 50% revenue growth in FY27 as defense orders that were delayed are finally expected to move into execution. The stock is currently trading around 715 rupees with a market cap of nearly 3,800 crore. The company ended FY26 with an order book of nearly 1,271 crore. That's more than 3 times its FY25 revenue. Over 90% of that order book comes from defense. Its customers include DRDO, ISRO, Bharat Dynamics and Bharat Electronics. The company is already preparing for future growth. It owns nearly 400 acres across 2 facilities and is investing around 70 crore to expand capacity. The biggest risk here also is execution. Now let's move on to stock number 6, Yasho Industries. You know, sometimes the biggest growth opportunity isn't a company building a new factory. It's a company that has already built a factory but still has plenty of room to use it. That's basically Yasho Industries. They make specialty chemicals used in lubricants, rubber, personal care and food products. It exports to customers in more than 50 countries and is working as a long-term R&D partner for global chemical companies. Market cap is around 3,500 crore right now. In FY26, its plants were running at only 60% capacity. At first, that may not sound great, but it also means the company can increase production significantly without spending on new factories. If demand improves, that can also support margins, and the company is preparing for that growth. It has added new manufacturing lines, set up a new R&D center, and signed a 15-year manufacturing agreement with a global multinational. It has already received an advance of 51.4 crore, and commercial production is expected to begin in FY28. Because of all of this, management is guiding for 35 to 45% volume growth in FY27 and is targeting 1,500 crore in revenue by FY28. The plan is simple: make better use of existing capacity, add more value-added products, and improve profitability as utilization increases. The risk here is Chinese manufacturers compete aggressively on price in this space, and they are still carrying a bit of debt, so managing cash flow carefully matters here too. Now let's move on to stock number 7, KDDL. It's best known for making watch dials, hands and precision components for some of the world's leading watch brands. It's also the parent company of Ethos, India's largest luxury watch retailer. But here's what's changing. KDDL is no longer just a watch parts business. Over the last few years, it has quietly built two new growth engines. First is iGen, its precision engineering business, which makes high-precision components for the automotive, aerospace and industrial sectors in the US and Europe. Management expects this business to grow 20 to 25% every year, which is why it's investing around 50 crore in FY27, largely into iGen and its bracelet business. The second is Orna Pack, which makes premium packaging for luxury watch and jewelry brands. Management believes this business alone could add 80 to 100 crore in revenue over the next few years. Together, these businesses are reducing KDDL's dependence on the traditional watch parts business, and the numbers are already showing some of this. FY26 standalone revenue came in at 506 crore, EBITDA at 117 crore, which is a solid 32% margin. Their new steel bracelet division is running at 75 to 80% utilization, and Favor Luba, one of their watch brands, is expected to double sales this year. The company currently has a market cap of around 3,000 crore. The risk here is a big chunk of KDDL's manufacturing business still depends on global luxury watch demand, especially out of Europe and Switzerland. If premium watch sales stay weak, export orders could take longer to bounce back. It's also a business that needs a lot of inventory and working capital, and currency swings can still bite into earnings despite their hedging. Now let's move on to stock number 8, Uniparts. It makes highly engineered components used in tractors, construction equipment and other off-highway vehicles. These parts go directly into the machine during manufacturing. They are not aftermarket spare parts. So what's changing? For the last couple of years, the problem wasn't Uniparts. The problem was its customers. Global tractor and construction equipment companies had built up too much inventory, so they cut production and stopped placing new orders. Now management says most of that excess inventory has been cleared and orders are starting to come back. That's why it's guiding for around 21% revenue growth in FY27. The stock is currently trading around 676 rupees. FY26 also marked the beginning of the recovery. Revenue crossed 1,188 crore, and despite weak global demand, the company maintained healthy profitability. Its balance sheet is another strength, with a return on capital of over 24% and debt to equity ratio just 0.11, making it almost debt-free. Management also expects North America, one of its biggest markets, to return to growth in FY27. Over the last 12 months, the company has already won around 225 crore worth of new business, including orders from the energy storage sector. It's also expanding its presence in North America with a new warehouse in Mexico and has got quality approvals across 3 facilities. The biggest risk here is that the business is closely linked to global farm income and construction activity. Now let's move on to stock number 9, Zaggle. Think about how many payments a large company makes every month. Employee expenses, vendor payments, reimbursements, corporate cards or payrolls. Managing all of that manually can be a huge task. That's where Zaggle comes in. It helps companies manage all these payments in one place, making it an important part of their finance operations. The stock is currently trading around 205 rupees with a market cap of nearly 2,758 crore. But here's what's changing. Zaggle isn't just trying to add more customers, it's trying to sell more products to the customers it already has. The numbers back that up. FY26 standalone revenue grew 42.2% to 1,853 crore and profit grew even faster, up 52% to 133 crore. Their enterprise customer base is now at 3,915 corporates serving 3.9 million users on the platform. For FY27, management's guiding for 25 to 30% standalone revenue growth. The company has also acquired Green Edge and RivPay technology, now called Zag.money. These acquisitions have added products like loyalty programs, cross-border payments, UPI and consumer credit cards, giving Zaggle more opportunities to earn from each customer. The biggest risk here is whether the company can execute well as it scales. Now let's move on to the last stock on our list, Pitti Engineering. It makes critical components which are used inside electric motors for industries like railways, hydropower and renewable energy. The stock is currently trading around 947 rupees with a market cap of nearly 3,500 crore. But here's what's changing. Earlier, the company mostly sold basic components. Today, it's moving up the value chain by supplying machined castings and fully assembled products, which are much more profitable. And the difference is huge. Basic castings generate around 30,000 to 35,000 EBITDA per ton. Machined castings earn around 80,000 to 1 lakh per ton, while fully assembled products earn even more. So the same raw material can generate much higher profits simply by doing more value-added work. The company has also built a fully integrated manufacturing setup handling everything. Today it serves more than 100 customers across 11 plus countries, and the numbers are also improving. FY26 total income grew to 1953 crore. Exports crossed 531 crore, which is up 43% from FY23, and now they contribute 27% of total revenue. For FY27, management is targeting around 2300 crore in revenue. To support future growth, the company has announced a 290 crore greenfield expansion, increasing casting capacity from around 24,000 tons to 36,000 tons. Demand also remains healthy across various sectors. The biggest risk here too is execution. So these were the 10 small cap stocks, different industries, completely different stories, but every single one of them is trying to build its next chapter. So my honest suggestion for you is to watch the business and execution closely over the next few quarters. Now if you want a proper deep dive on any of these, just drop the name in the comments and we'll take it up. And if this actually helped you, then do like and subscribe for more such investor-centric deep dives. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.